So what I want to talk about today is the 5 slam dunk candle patterns, which are going to really help you to make some really good decisions in your trading. So I'm going to highlight what those candle patterns are, and then we'll go through them one by one, and I'll give you lots of examples and tell you how to use them. So the 5 candle patterns are, let's write it up here. One is the spikes, and that includes hammers and hanging men. It's actually hanging man, but I'll call it hanging men. And we'll also talk about just general spikes. The second one I want to talk about is engulfing patterns. And the third one I want to talk about is full stops. And the fourth one I'm going to write down here is dark cloud covers or piercing pattern. Same thing. And I'll go through those individually. And the final one is the one up, one down pattern. Okay, so those are the 5 patterns: spikes, and that includes hammers, hanging men, and just the general spike type of patterns. And then we've got engulfing patterns, and that could be bullish engulfing and bearish engulfing patterns. Then we've got full stops, which are very small candles. I'm going to talk about how to use those. Then we've got dark cloud cover and piercing pattern. So I'm just going to abbreviate that to dark cloud cover and or piercing pattern. And then I'm going to talk about the one up, one down pattern. And that's an extremely reliable pattern, that one. So those are the 5 candle patterns. And let's go through them one by one. Excuse me. How to use them, and where to spot them, etc., etc. So the first one I want to talk about is the spike candles. Now that can really be one of 3 things, and let's just scroll back along this chart, and I want to show you some examples. I've got an hourly chart here, and I'm just going to point out examples of spike patterns, spike candles, and then I'm going to go through the different types and how they can be traded. Alright, so there's a spike pattern, and this one here, that's a spike pattern, spike high in that case, and you can see this is characterized by a small body over there, small candle body, and then a long candle wick. Right, there's another one over there, and you can see we've got a small candle body over there, small candle body there, and a large spike low. Here's another one here. You can see that's characterized by a very small candle body, and then this large wick on the candle. There are plenty of other examples. Here's a really good example. This candle pattern right here. You can see you've got a very long wick on the candle, and then a tiny candle body. And I can just keep on going with these, and there's another one right there. This one, that's got a very small candle body and a very long wick. There's another one. This is a much smaller one, small candle body and long wick. There's another one, small candle body and long wick. And when I say a long wick and a small candle body, what I actually mean is that the candle body itself, in the case of a spike high, for example, the candle body is much smaller than the wick. Now, it doesn't mean that this whole candle has to be big or small. It could be a really tiny candle like that, or it could be a really long candle. But the prerequisite is that the wick of the candle, or the tail, as some people like to call it, is much bigger than the candle body. Now, spikes can either be up, in this case, or they can be down, like that. Okay, you can get them in both directions, and they can both happen at the top or the bottom of a trend. One more thing about spikes is that the candle body doesn't necessarily have to be white or black, in other words, bullish or bearish. It can be white or black. Doesn't make any difference to the way you interpret the candle. Same in this case, you can have a white candle body or you can have a black candle body. It makes no difference as to the way in which you interpret the spike. Alright, so let's have a look at some more examples, and you'll get the hang of it as we go along. So there's another right there, small body and a large tail. In that case it's a spike low. There's another example, tiny candle body and a long wick or tail, and that's a spike high. Now, normally when you're looking for a reversal, the basic pattern or the basic spikes are when you get a spike high at the top of a long move or a spike low at the bottom. So there's one basic sort of format in which you use is a spike high at the top and a spike low at the bottom. And what these signify is that the price may well reverse, and they would be an entry signal to get into the trade. In this case you want to go down short, in this case you want to be buying and to go long. Alright, let's have a look at a few more examples. There's a good example right there of 3 spikes, actually 2 in a row, and you can see that these candles here are very tiny compared to, say, the ones that we had a look at earlier, or for example this one here. There's a spike low and there's a spike high, but you can see these candles are much smaller than that candle there. It doesn't make any difference. What we're looking for is the actual pattern itself, and as I said, you can have a spike high that big or a spike high that big. It's more or less the same sort of thing, and I'll discuss the different ways to use both of these patterns in a moment. Let's continue to have a look at some more examples just so that you get a feel of it. And wherever I go on the chart, I can see that these take place. There's a spike high right there. There's another spike high immediately after that, and there's a couple right here as well. So there's a whole bunch of them in a row. There's a spike low right there. There's a spike high, a very small one. There's a spike low down here. And you can see that these take place all over the charts. Not every one of them works out to be a proper entry or proper reversal, but a lot of them do, and obviously that we have to be selective about the ones we choose by using certain techniques. There's a spike low, okay, let's call it SL. There's a spike high there, call it SH. There's another spike high there, SH. There's another spike low there, SL. And so you can see that these patterns occur all over the show. Now, whether you're talking on a 5-minute chart, or a 1-hour chart, or a day chart, or a week chart, even a 15-minute chart, 30 minutes, whatever your preference is, whatever you're trading, these candle patterns can be used to add to your armor. Now, as a general rule, the candles, candle patterns, in terms of the probability of them being accurate, generally from 5-minute charts up to, let's say, day charts, the probability, the accuracy of candle patterns increases. In other words, on a 5-minute chart, just let's say, for example, they are accurate 30% of the time. And that figure's just a total thumbsuck. But let's say on a 5-minute chart, candles are accurate 30% of the time. And as you go up through 1 hour, 4 hours, etc., all the way up to day, the candle probability or the accuracy or the usefulness of candles increases. Let's say when we get up to day charts, it's 70%. Just for example, that's the probability of it working out. These are not accurate figures, but so when you're trading on a 5-minute chart, just be aware that candles can often be false signals, but as you go up to daily and weekly, even monthly charts, candles can be extremely accurate. And so you've got to be careful how and when you use them. So we're talking about spike highs. Now, what we can add to spike highs and spike lows. So remember, we've got the two basic patterns. That's a spike high and a spike low. Spike high takes place at the top and signifies a reversal down, and a spike low takes place at the bottom and signifies a reversal to go up. Okay, those are the two basic patterns. Now, there are two other variations of spikes, and they are called hammers and hanging men. Now remember, let's just have a look. At the top of a trend, we're looking for a spike high. So we'll see some candles coming up like this. We'll see a spike high and the candles going down. And that's the reversal right there. Now, you can also get the complete opposite type of spike at the top of a trend. So we can have the trend going up like this, and we can get a spike high, which is in reverse. In other words, sorry, it's a spike low at the top of a trend. So we've got a spike high at the top in this case, and we've got a spike low at the top in this case. And that also signifies that we could get a reversal downwards. Now this candle pattern, that candle there, is called a hanging man. A hanging man. And the reason it's called a hanging man is because that's the sort of shape that it's in. And it's at the top of a trend, and it's hanging down like that. My pen seems to be going skew. So it's at the top of a trend, it's hanging down like that, and there's the sort of arms of the man, and there's the body and the legs. So it's a hanging man, and it occurs at the top. Now the same thing can occur at the bottom of a trend. Now remember, I said when you reach the bottom of a trend, what we're looking for, let's just get rid of that off the screen. When we reach the bottom of a trend, what we're looking for is a move down like this. Whoops, let's do it over here. There's a move down like this, and then we want to see a spike low, and then the trend moving up again, and that signifies a reversal. So what we're now looking for is the same sort of thing, but in this case we've got the trend going down, and we've got a spike high at the bottom of the trend instead of a spike low, and then the trend reverses and carries on upwards. Now that candle there is called a hammer. I had to look at my notes there for a while. That's called a hammer candle because it looks like a hammer. And what they often say is that candle's hammering out the bottom of the trend. It hammers out the bottom. And that little pattern there is called a hammer pattern, and that can also take place at the bottom. So what we've got now is we've got spike highs, and we've got spike lows, and we've now discovered that either one of these can take place at the top of a trend or at the bottom, and both of these signify reversals. Now, while we're talking about hanging men and hammer candles, that would be a hammer at the bottom of a trend, and it would be a spike high at the top of a trend. This one would be a spike low at the bottom of a trend, or a hanging man at the top of a trend. So what we want to do, each one of these is a sign of reversal, and these candle patterns signify that we're getting a potential change in direction. And what we want to do is to take note of these candles, and if we get a hanging man, now okay, let's talk about the top of a trend, and talk about how we use these at the top and how we use these at the bottom. Alright, so let's have a look at what happens at the top of a trend with either one of these candles. And let's use this example here. We could even use that one right there. But let's use both of them. What we want to do here is when we see that sort of candle at the top of a trend, and remember that we don't know where the top is, so we'd be looking at the chart, something like that. We don't know if that's the top of a trend, but we see the reversal candle, the reversal pattern. And what we want to do then is as soon as we see that pattern, we want to take the trade downwards. Now there are two ways to do it. You can either just enter the trade as soon as you see the pattern, or you can wait for confirmation. And confirmation means that we're looking to see the price move below the low of the candle, which was the spike. All right, so you can either wait for it to move down, or you can enter the trade at that price as soon as the hour or the 5 minute or whatever rolls over. And it's really simple. When you enter the trade, when you make a decision to enter the trade, and remember the videos that we had previous to this, the previous videos on the TNT system, last week we talked about how to do all of this. So I'm going to really talk about these candles, not so much in terms of how to trade them, but I will cover that, but in terms of spotting the candles and entering the trades. Now it's very simple. We enter the trade, and let's say that's at, say, 133 or so, and we put the stop loss above the high of the candle that gives us the signal. So the high of that candle is 133.35, let's say. 33.35, 33.35. And remember, if we're selling and we want to put the stop above the high of the candle, we need to add the spread, which might be 2 pips in this case, and we need to add a little bit of a safety buffer, and I would say normally 2 to 5 pips. So we add that on top of the 3335, and that's where the stop loss goes, and so on and so on, and we see the price move down. Let's have a look at this other example where the stop loss is much smaller. That was up here, and we get another couple of spike high candles, and what we do in this case is we've got 2 spike high candles, and I'm not covering this in the 5 patterns, but when you get 2 candles with almost the same high, preferably within a pip or 2, and you get both of them have got spikes like that, that's called a tweezer. It's called a tweezer. Now this can happen anywhere with any candle pattern, any shape, but basically it means that if you get 2 candles at the bottom of a trend, and they're sort of reversal candles, and you've got the bottoms of the candles exactly the same, that's called a tweezer bottom. And here we've got a tweezer top. Both candles have got the same height. Now, but that's beside the point. What we've got here is 2 reversal candles. If we didn't get in on the first one, we would have the chance to get in on the second one. And once again, you basically get in at the close of the hour. In this case, it would have been there. In this case, it would have been a little lower. At the close of the hour, wherever the candle closes, or you can wait for confirmation by allowing this to move down beneath the low, as it has done here. And we put the stop loss above the 2 candles, or above the highest candle, and in this case it would be around 133.90, the entry around 133.60. Remember to always add the spread, and plus 2 to 5 pips for safety. Okay, so that's really how you use them. Now, when you get a hanging man, and the same goes for the bottom of a trend, okay, we can look for an example there, same sort of thing. A lot of this stuff will come out nicely in the webinars and the recording of the webinars, but here you get a spike low right there. It's not a great one actually. I'm not going to highlight that one too much because the candle body is, that's more of an engulfing pattern. But let's find one where we get a genuine spike. And there we go, there's one right there. You can see the candle body is smaller than the wick, which is much longer. And we enter the trade either at the close of the candle or as soon as we make a new high above that previous candle, and we put the stop loss beneath the low of the candle. And in this case, we don't have to add the spread, because if we exit the trade at the stop loss, it will be actually selling, so that we don't have to worry about the spread. So we just add on the 2 to 5 pips below the candle, and that's where the stop loss goes. Now, what I want to talk about is hanging men and hammer candles, and these offer what I call these no-brainer trades, and that's what's nice about them. They don't have as much high probability of the reversal actually working out as do the spike lows and spike highs. Those are normally very accurate, and they have a high percentage of probability of winning. But when they don't win, sometimes because of the size of the candle, your stop loss is pretty big. Whereas with a hammer candle or a hanging man candle, you can get in with a really small stop loss, and that's what makes it a really good opportunity, like a no-brainer. So let's just have a look right now. I'm going to give you this example. Perfect timing here. Now this is where we are right now as I'm making this video. I don't know if this trade's going to work out, but it's a jolly good example. Now let's have a look at this. We've had a hammer candle right there. This candle here. Sorry, it's not a hammer, it's a hanging man. And that's exactly what I spoke about before. Now I don't know if this candle pattern is going to work out. Look at that spike high there. That one moved down a bit. There's a nice spike low. That one we actually missed yesterday, and it had a good move higher. But I don't know if this hanging man candle is going to work out. But just have a look at the numbers, and you'll see why it's so attractive to get into a trade like this. Look at the close of the candle there. The close of the candle is 4005. Okay, 4005. The high of this candle right here is 4014. Now that would be our selling price right there. It looks like actually this trade's going to go against us, but nevertheless it's a good illustration. Our selling price would be our entry price to sell, all right, because we want to go down. Our entry price to sell would be 4005. The high of the candle is 4014, and we add the spread. In this case, I've got a 1 pip spread, and in order to keep the stop loss really tight, I would put a 2 pip buffer on there. So I would put my stop loss at 400. Sorry, let's cancel that. I'd put it at 4017. My selling price 4005. My stop loss 4007. That gives me a 12 pip stop loss. 12 pip stop loss on an hour chart, and that's absolutely fantastic. What's nice about trading on hour charts is that if you have a 12 pip stop loss, you're not aiming for 20 pip gains or 30 pip gains. On an hour chart, we can often aim for much more. Let's say 60 pips or 100 pips, or even let's say 120 pips. That's the sort of thing we'll be targeting on an hour chart. Well, let's start at 50. Somewhere between 50 and 100 is reasonable. So if we were only risking 12 pips, we've got the opportunity to risk 12 pips, but to gain, let's be extremely optimistic, but let's say to gain 100. That's an 8-to-1 reward to risk ratio. And if you can get into as many trades as that, these no-brainer trades with tiny stop losses, you can lose probably 5 to 8 trades in a row and still cover that with one single winning trade. That's what makes it so fantastic. And that's what I like about, there's the trade still, it's still hanging in there. That's what I like about hanging men candles. You can get in with a very small stop loss, and with a bit of luck, this one, it's now 9:30 in the morning, so we've still got half an hour to close this candle. But with a bit of luck, that one will also close as a hanging man, and we'll get 2 hanging man candles in a row, and that would be a really good sign that we're going to get a nice move down. Just think about that, risking 12 pips to maybe get 100, maybe even more than 100 in this case, and that gives us an 8-to-1 and maybe even a 10-to-1 reward to risk ratio. That's the kind of trading that you want to do. That's what makes you money, when you have your risk really low and your target really high. And that's what we talked about in the previous videos. That's a no-brainer. Let's have a look at the same thing at the bottom of a trend when we've got a hammer candle. Remember, at the top of a trend, it's called a hanging man. Top of the trend, it's a spike low, tiny body. You can get in with a very small stop loss. Hanging man candle. You can get the same thing at the bottom of a trend. Let's see if I can find some examples. There's an engulfing candle. We're going to come back to that. Let's look for a hanging man. It's very difficult to find them sometimes. Sorry, a hammer candle. There's a couple of reasonable examples. These are not the most beautiful examples of a hammer candle, but you can see in this case right here, this candle, we've got a long-ish tail. Actually, it's not a bad example at all, and a very small body. And we followed that by the same thing, a longish tail and a very small body. And these are both spike highs at the bottom of a trend, and that makes them hammer candles okay, because they're spike highs at the bottom of a trend. And what that means again is that we can get in with a very small stop loss. We can get in there at the close of this candle. Let's have a look at it more accurately. We can get in at the close of that candle with a stop loss. We would get into, well, we'd actually get into this candle before that. The entry price is 134.31. So 34.31. That's the entry price of this potential trade. The low of this candle is 34.19. That's 12 pips away. We put our stop loss just a little bit beneath there. Let's say 34.17, and we'd have to pay the spread to get into there. So it would be 34.32. 32, and our stop loss at 1.7. So what's that at? 27. That's a 15 pip stop loss. Again, very similar to the one we had a look at before. That's a no-brainer. No-brainer. We're going to risk 15 pips, and the possibility is 50, 70, 100 pips. And in fact, let's have a look at where this trade did go. Can't remember. I have no idea. So we got in at 34.40 roughly, and in fact, it went up 100 pips. Just like that. Might have even gone higher. In fact, it went up 200 pips. That's one of the no-brainer trades I'm talking about. All right, so that's covered the first type of candle pattern that I wanted to talk about. And the other one now, okay, let's just make some notes. So we've talked about spikes. Remember, that covers spike highs, spike lows. So spike high would be at the top of a trend, spike low at the bottom. And we've talked about hanging men, and we've talked about hammers. So all of those are spikes. They're all different, and you can use them in the ways I've just described. Now, I think that trade is almost stopped out. We'll have to see what happens. Not quite yet, probably. Maybe almost. All right, so the next one I want to talk about is engulfing candles. All right? Engulfing candles. And these are really good candle patterns. And again, remember, what I'm teaching you here applies to any chart. It could be a 5-minute chart, could be a week chart, but as you go higher in the time frame of the chart, candles become more reliable. So just remember that, but you can use them on all charts. Now, engulfing candles are very simple. They are candles where, and you can get two types. You can get bearish, and that's normally at the top of a trend, and you can get bullish, naturally, at the bottom of a trend. So we want a bearish engulfing candle at the top so we can sell. We want a bullish engulfing candle at the bottom so we can buy. And again, these signify reversals. So what a bearish engulfing candle looks like is you get a bullish move, let's say like this, near the top of a trend. So we've had a move up, and you get a candle like this, and then you get the following candle. That's a bullish candle, and the following candle becomes a bearish candle. So you get the move up and then the move down, and why it's called engulfing is because the body of this candle, okay, we haven't put any wicks on, doesn't really matter about the wicks, we just look at the body. The body of this candle has engulfed the body of the previous bullish candle. So it's the body of this candle basically is larger, and it contains, inside its length, contains the body of this candle. So that's a bearish engulfing pattern. The same thing happens at the bottom of a move, and I don't even have to draw this because we've got a great example right here. And there is the bullish engulfing pattern. All right? I don't even have to draw it, which is fantastic. So we've got this bearish candle here, that black one. It's moved down at the bottom of a trend, and then we've got this bullish candle right here, which engulfs the bearish candle and causes a reversal in the trend. And in fact, this one here was a couple of days ago, and we even spotted that trade. Unfortunately, it took place after our trading time was complete because we had gone short based on this bearish engulfing candle. This is a very large bearish engulfing candle. You can see that it's really just swamped this candle and moved down, and then we get the bullish engulfing candle at the bottom, and we get a move up. Now, you can see that not all candle patterns work. For example, there's a spike low that didn't work, but I'm going to point out to you something. I want to do it right now before I forget. When you have a very strong, and this applies to all the candle patterns, just going to make a quick interjection here. This is really important, and it'll make a big difference to your trading. I'm going to come back to the engulfing patterns shortly. Now, just make a note of this, and this applies to any of the 5 candle patterns at any stage in your trading. When you get a very strong move like we've got here, this is a very simple concept. It's going to take you 1 minute to listen to it, but make sure you grasp it. When you get a really powerful move, like we have there, or like we have here, really powerful move, don't take the first reversal candle that takes place after the move. So we've got a massive bearish candle. Don't trade the next candle, even if it looks like it's a reversal candle. Wait for 2 or 3 candles. And you can see in this case we had to wait for 3 candles, then we got the confirmation, and then we went higher. We moved up, and we would have avoided being stopped out. The same thing here. We get a big strong move. In this case it was okay because we wouldn't have been stopped out. But don't take the first reversal candle or even the second. Wait for a third one, and even more than that, you could have waited for this one. And the reason for that is because often these candles at the end of a very, very powerful move are not necessarily the stage when the trend will reverse. They're often just pauses, just brief pauses in the market before it continues with its merry way, and then we can continue to trade in the opposite direction if we get a reversal. Here's an example here. You can see we had a strong move. There was the reversal candle and pattern, but it continued higher. Don't take the first stage of reversal. Don't trust it. In fact, there's an interesting pattern there which I'm going to cover shortly. Again, here, it's a good example. Strong move. Don't take the first reversal candle. Wait until you have a very clear candle after 2 or 3, and there was one there. Managed to get some pips out of that. Let's have a look at some more examples. There's one that did work out actually. Let's have a look at some more. All right, we'll come back to that, but I'm going to show you some examples a little later on. Now, I'm just going to pause this and take a sip of water. All right, incidentally, while we're talking, look at this candle pattern forming here. Potentially, there's another 20 minutes to the end of the hour, so potentially we might get another reversal candle there. And that kind of demonstrates what I've just been talking about. All right, so let's talk about engulfing patterns again. There's a good example. Bullish engulfing pattern took place at the bottom of a move. Engulfing patterns are very reliable, and you need to learn how to spot them. There's a bullish engulfing, excuse me, I'm getting them all mixed up because I've been talking for so long. There's a bearish engulfing pattern at the top of a move. Just let's look at some of these. Let's find some more. Okay, that one we're going to talk about a little bit later. That's a dark cloud cover candle pattern. There's a piercing pattern, but I want to talk about the bullish engulfing patterns, and I'm just looking for some examples. There's a bullish engulfing pattern right there, beautiful example. There's a bearish engulfing pattern, another great example. So those are all engulfing patterns, and I think they're quite easy to spot, and that was number 2 on our list, engulfing. Good reliable candle patterns, and if you see a really good one, then you can be assured that there's a good probability of the reversal taking place. The third one I want to talk about, remember the first one was the spikes, including the hanging man and the hammer candle, spike highs and spike lows. Second one is engulfing. Third one I want to talk about is full stops. Now, again, a full stop is a very attractive candle pattern because it allows us to get into a trade with a tiny stop loss. And it normally occurs after a very powerful trend. So we want a very strong trend. Either up or down, and we're looking for a very small, a very tiny candle that takes place at the end of a long trend. Now, when I say tiny, what I'm going to suggest is that you look back over, let's say, 10 to even up to 30 candles, let's say 10 to 20 candles. And you want your full stop candle to be smaller in size than most of the candles in that sort of period. So we want something, a very, very tiny candle, and it could be just a little candle like that. It could be a little bearish or bullish candle. It could be just a little star like that. It could be a tiny little spike high or spike low, something like that. But the key here is that it's a tiny candle, and it allows us to get in with a tiny stop loss. Now let's see if we can find some examples. These don't occur as often as some of the other candle patterns, but they do occur from time to time. Alright, so we're looking for something really small, and there's a good example right there. Really tiny candle pattern, but this took place really in the middle of nowhere, so it's not of much help to us. But what I'm looking for is these minute little candle patterns after we've had a strong move. There's another example there, but again, it's not at the end of a move. Now, of course, I'm not going to be able to find one example for you, but now, there's a couple of good examples. Now, they don't always take place at the top or the bottom of a move. They sometimes take place in a group or a cluster of candles. Now, this has been a strong move up, okay? And we're looking at these reversals taking place, and we've got those two spike highs there, and tweezer top. I think we had a look at this one before. And then we get these two full stop candles. And that adds a lot of weight to this reversal. And what it actually means is that this reversal may well be forming and taking shape, and it gives you a lot more confidence. There's another example here, which I can actually point out. And where is it now? Okay, so we've got this reversal taking place here at the bottom of a trend, and you can see we've got this one down, one up, which I'm going to talk about shortly, another very reliable candle pattern. And we get these two tiny little candles here, right there, really tiny candles, and that adds weight to the fact that this reversal might be taking place. Now, these are what I call these full stop candles taking place around about the reversal, but you can also get them right at the top and right at the bottom. And here's a good example. We get a spike high right there, followed by another tiny little spike high, and we get these two tiny reversal full stop candles. Look at the size of, in fact, all three of these candles. Look at the size of them in comparison to all these candles back here. Don't worry about that one because that's over the weekend. This is weekend, so that's insignificant. But if we go back here, all the way back here, 1, 2, there's a small one as well, but on average 1, 2, 3, 4, 5, 6, 7, 8, 9, about 15 or 20 candles, and then you get these really small candles, and you get this nice move beginning to move down. In fact, there was a massive move down. All right, so as I said, there's a bearish engulfing candle, incidentally. Not actually, it's not quite. It's a dark cloud cover candle. There's another example. There's a good example of a tiny reversal candle. Let's just get the pen onto this one. You can see all of these candles here are kind of big, and then we start getting very, very tiny candles like that. And I think the next one as well. Okay, quite small, not quite as tiny as the one before that. And then that's also a bit of a doji candle, spike high. Then we get the move down. So there's a bearish engulfing candle, a good example of a really good bearish engulfing candle. There's another really good example of a bearish engulfing candle. So okay, these tiny little full stop candles, I've really struggled to find them, but they do occur. Not as frequently as some of the other candle patterns, but keep an eye out for them. And more particularly on daily charts, there's a good bullish engulfing candle, incidentally. And more particularly on daily charts will you see these full stop candles, but you often see them on 5-minute charts as well. I'm not going to go to a 5-minute chart right now, because I just want to use this hour chart. Now, dark cloud cover and piercing patterns. I'm going to take another little break for some water.